Thank you everybody for coming back to the channel. And today we're gonna discuss everything 1031 exchange. I know all about 1031 exchange. Well, I know most everything about 1031 exchange, but I am not a qualified intermediary. So I'm not qualified as a professional to tell my clients who are investors about 1031 exchanges. So that's why I'm here with Carmine Difulvio. He's here with Security First Exchange, and he's going to talk all about 1031 exchanges. So Carmine, tell us a little bit about what you do, how long you've been doing it for, and then we'll just go back and forth and talk all about 1031 exchanges.
Sounds great. Well, yeah, my name's Carmine Difulvio. I'm the director of Security First Exchange. I run our 1031 exchanges on a national level. So if people have questions, obviously I'm always here to talk to them, me and my team. I've been doing this now for almost 25 years. In my career, I've helped facilitate over 20,000 exchanges. So when clients have questions, that's what I'm here for. I'm here to help guide them through the process to make sure that when something comes up, when there's a pitfall, when there's a question, we're here to get it taken care of and work with their team. They're a real estate professional. Yeah. Maybe they're a lender. Everybody's got to coordinate to make sure that sale and purchase get done properly
and smoothly.
Yeah, we're part of the team now. Yeah. You're the captain of the ship. I'm just one oar on the water. But
yeah, very important oars for my investor clients.
Yeah, we're gonna help take care of everybody.
Okay, so tell me basically what a 1031 exchange does. It's for tax deferral purposes, correct?
Yeah. A lot of people say tax-free. Obviously, that's not exactly correct. 1031 tax-deferred exchange, been part of the tax code since 1921. And what it does is it allows investors to sell investment property, buy investment property. And as long as they follow the rules of the 1031, they defer their taxes. So they defer that tax from the property they're selling into the property they're buying. So basically through the process, when they buy that new property, they already owe tax on it because that tax got deferred to the new one. Yeah. But what it allows you to do is instead of paying the tax, you get to keep those tax dollars. You get to use that money to reinvest in a new property. So that's the benefit of 1031. It's like an interest-free loan from the government. Yeah. Instead of paying it today, you defer it, you use that money to buy something else, and you're making money on this money you're supposed to give up.
Yes. And this helps for my clients who want to build their portfolio because they can do this over and over and over.
I have clients that call every couple of years, maybe, and just say, new exchange, I'm selling again, and they just keep on doing it. Yeah.
Okay. Let's get into the ins and out of 1031 exchange. So from what I know, you have 45 days once you sell your property to find a like claim property, correct?
Yeah, so from the closing of the sale, there's 45 calendar days to identify with the qualified intermediary exactly what you're gonna buy. So you can't just say a house in Las Vegas or a commercial property in Dallas. No, it's gotta be property, address, city, state. You gotta be specific, has to be an unambiguous identification.
So address or tax identification number to identify that property.
Yeah.
And then after the 45 days, you identify it, you have 180 days to close on that property, correct?
That's right. 180 days from the closing of the sale till you have to close on the purchase. Obviously, you can close at any point within the 180, but that's the maximum time frame, 180 calendar days.
Okay. And people get confused and ask me, what's a like kind property? Because it has to be like kind, right? So my understanding, it has to be an investment property. It can't be personal use. And we'll go over vacation properties after we figure out what like kind of properties are.
Yeah, it just means any real property held for investment purposes.
Okay.
Raw land, single family, duplex, condo, commercial, as long as it's held for investment purposes, it qualifies. And that's one of the biggest confusions. We get calls all the time saying, I spoke with my real estate professional, I'm selling a house, I gotta go buy a house. No, you don't. You wanna sell that single family, you go buy maybe 2 condos, leverage out, or to buy some land. You can do that as long as it's held for investment.
So the key word here is like kind is investment property.
Exactly.
Okay. So here's another one I get. I have a vacation home. Can I do a 1031 exchange on my vacation home?
So 2 ways there. I'll go. If I own a vacation home, I probably can't do a 1031 exchange because you have to hold the property for investment. And even though taxpayers will say, and I get this all the time, well, this is the biggest investment I'll ever own. It's not held for investment. It's not treated like an investment on your taxes. So you've got to be renting it out. If you're renting it out, then you could do a 1031 and go buy a vacation home, but you're limited on how much time you can use a property. So whether you own it now or you want to buy a vacation home, shall we say, normally you can only use it personally for 14 days a year. And then you have to rent it out for at least 14 days a year. So you can rent it more. You can rent it for 50, 100, 120, I don't care.
Yeah.
But the personal use is going to be limited to that 14.
Okay.
So,
it's kind of it's like a timeshare.
Yeah, you don't get it much, But if you own that second home in, I don't know, St. George, Utah, is it going to be an exchangeable asset? Probably not, because you haven't rented it out.
Yeah.
Now, can you convert it? Yeah. Sure. Just start renting it out. Move out of it, stop using it, rent it out for a year or two, check with your tax person and see how long they want you to rent it. But normally it's a year or two. And now you could do a 1031 exchange on it.
Okay.
And then vice versa, kind of works the same way too. If I own a true rental property, I could sell it. This is a great retirement plan. So hear me out on this one.
Okay.
I sell a property here. It's been a true rental. I rented it for 5 years. I do a 1031 exchange, no problem. And let's say I want to retire in Maui. Go buy the property in Maui, rent it out for a couple years, and then you can move into it as your retirement home. Because the code doesn't say how long you have to hold it as a rental. Most tax people will say 2 years. So rent it out for a couple years. Can you have personal use of the property? 14 days a year.
Yeah.
So I go buy that property in Maui, Airbnb, VRBO, and I rent it out for 100 days, 150 days per year.
Okay.
I can use it up to 14. So I still get to go to my Maui property, but then after 2 years, I could stop renting it out. And now it's just my second home.
Okay.
And it's a great way to buy that retirement home through a 1031 exchange.
Okay. So when I retire and I move there and make that my primary home, do I have to pay those taxes?
No, taxes only due at one point. When you sell
it.
Yeah.
Okay. So
you just bought
it's
your
a little
retirement
loophole.
home.
You just got that little loophole. Okay.
Yeah. And that was under a revenue procedure that came out where it talked about how long you can rent it out. And it's a great strategy. Of course, people need to work their tax professional to gear all this up because everything's going to be reported on your taxes. And let's be honest, it doesn't matter what you do. It matters by how you report it on your taxes.
Yeah.
So the tax person's got to be involved. But I tell you right now, will I buy my retirement home through a 1031 exchange? Yes. Okay. I will sell a rental. I will buy my retirement home, rent it out for a couple years, and then kick everybody out, move in, and I'll be done. Maui? Nice. I don't know. But someplace, I'll be doing that.
Nice.
Yeah.
Cheat code, professional. Yeah. So you are not a tax person. You're a qualified intermediary.
Right.
So tell me the difference between a qualified intermediary and a tax person, because when you use a 1031 exchange, you have to use, let's do a QI.
Right.
Which is you.
Yep.
And so explain that a little bit.
So a QI fills the role required by the IRS. The tax code says you must hire a qualified intermediary, or QI for short, like Shane said, to do your 1031. What role do we fill? Really, there's two main things. A lot more, but I'll simplify it. We document the transaction and we hold the funds. So document. We work with your title company before the closing. We document the 1031. Everything is signed before the closing. Before the closing. It has to be done before closing. Okay. I can't tell you how many times people have called. They call on a Monday and they say, well, Friday we closed our deal. The money's sitting at the title company. Over the weekend I was talking with my neighbor, my friend, my tax person. I want to do a 1031. That sounds like a great idea. I get to save my money.
Yeah.
And I have to break the news that they can't because it's too late. The deal closed on Friday, even though the client doesn't have their money yet. It's a term called constructive receipt. The money was due to the seller Friday when that deal closed. So because it was due to them, it's taxable. So what you have to do is hire a qualified intermediary like us. We document everything, have all the documents signed before the closing. So now when it closes on Friday, the money's not due to the seller. It's due to us as the qualified intermediary.
Yeah.
So now they get the tax deferral. So all the documents are done, signed, deal closes. Title company sends the money to us, not to the seller. Now those time frames start, the 45 and 180 days that we talked about. Client finds a new property, identifies it, gets it under contract, opens escrow with the title company. Same title work gets done. We prepare documents for the purchase. And now when the purchase closes, we just wire your money into that title company.
Yeah.
Now the purchase closes, everything's been done.
Okay.
So what the roles we fill, documentation and the holding of the funds.
Okay.
We do a lot more than that.
Yeah, of course.
We talk with the clients all the time about the process. How does the process work?
Yeah.
What are the basics of a 1031? But like you asked, how are we different than a tax person? I can't give specific tax advice because I'm not your tax person. So, Shane, if you ask me a certain question, will I give you my best guess? Yeah, but I don't file your taxes.
Exactly.
So I don't know if it works for you specifically.
Yeah.
So what I'll normally do is say, well, here's what I think. Talk to your tax person and double check with them. So having a tax professional is vitally important. And having them involved in a transaction is important as well, because all of this has to be reported on your taxes at the end of the year. And what are you doing this for? Tax deferral. So you need to be in conversation with the tax person. They need to know what you're doing. They need to understand the process. And that being said, you need to have the right tax person.
Exactly.
There are some tax people I've dealt with that have never dealt with real estate.
Yeah.
An investor in real estate should have a tax person that understands the real estate transaction. So
Yeah. So they're part of the team. Like you get your real estate guy. I can answer questions about 1031s, but I'm always going to refer my QI, and he's always going to refer the taxes. About your network. I keep saying this over and over again. In real estate or any business, your network is what makes you or breaks you.
great.
So having a strong network like people like you is amazing. So you were talking earlier about when somebody identifies a home in that first 45 days.
Yeah.
Do you send them over documentation to get the address or tax code or whatever?
Yeah. So the way the identification process works, and again, this is how it works here at Security First Exchange. When your sale closes, we get all the documentation from the title company. So we're going to send our client a summary of the transaction. Your sale closed on this date. Here's how much money you received from your 1031. And we also send them a form for identification purposes.
Okay.
To identify the property to us, that's easy. They just write down the property address, a couple of addresses on the form that we give. That's very simple.
Yeah.
Finding the property, you have that hard job.
Yeah.
We don't hit the streets with you.
Yeah.
So, but yeah, you're going to help them find the property. They just write it down in this form, send it in to us. That's a no-brainer.
Okay. We are talking about extensions because in taxes you get extensions. On 1031 exchanges, the 45 days to identify, the 180 days to close on a deal.
Yeah.
Can I get an extension on that?
That's a great question, but here's a bad answer. No. The only time there's ever type of an extension is when there's a federally declared disaster area. So earlier this year, there were a couple of hurricanes that hit Florida. Those taxpayers did get extensions because obviously some of them couldn't even leave the house for a week or two. There's a website that we give all of our clients where if something comes up, right on the IRS website, it says who gets the extension. So we can never tell somebody if they qualify because I don't know. I don't know maybe your permanent address, or I don't know. Sometimes you get an extension. Even you might live in Chicago, Illinois, but you were looking for property in Florida. Mm-hmm. Well, you could get an extension if the property you were looking at is now destroyed.
Okay.
So there are different ways a taxpayer can be impacted. Mm-hmm. Who needs to claim that? The tax professional does. So another role for the tax person is to say, yeah, I think this works for you. We can claim an extension. So they'll get extra time for that 45 and 180 days. But a standard taxpayer, just holidays came up. I didn't find a property. I need more time. Yeah, no extensions.
Yeah, so the only excuse is natural disasters as you get for extensions. So pretty much no extensions.
So when taxpayers do a 1031 exchange, the two key things are the time frames, the 45 and 180 days, then the financials. When you do a 1031, you always need to buy roughly equal or greater than what you sell. So if I sell a house for $500,000, I need to go buy $500,000 worth of property. It doesn't have to be one, it can be multiple. So if I sell one house for $500,000, can I go buy two condos for $250,000? Sure. Can I go buy more? Of course. If I sell a house for $500,000, can I go buy $1 million house? Yes. But the minimum is that equal or greater. And that gets a little flexible. You can deduct some closing costs, which I don't really want to go into here. That would take me an hour to do. But there's some closing costs, but roughly equal or greater than what you sell. And they don't have to be in the same state.
Okay.
What if I sell a property in California for $500,000? Can I buy a $250,000 condo in Nevada and a $250,000 condo in Arizona? Sure. So as long as you meet the requirements, you're going to defer your tax. And in doing that, what you have to do is you have to spend all your cash that comes into the exchange, and you have to reacquire debt. So on that $500,000 house that I sold in California in this example, what if I paid off $300,000 in debt? So I only netted $200,000. So the $200,000 comes into your 1031 exchange account. You have to spend all $200,000 as down payment on what you buy, and then you needed to buy $500,000.
Yeah.
But you only have $200,000 in your exchange account. So what are you gonna have to do? Go get another $300,000 debt or more.
Yeah.
Do that, you're gonna defer your taxes in a 1030.
So you mentioned out of state. We're booming right now. Las Vegas has been booming for a while. So we get a lot of people from out of town that want to invest here. So how does that work from out of state people coming in here to do 1031 exchange?
We work with out of state clients all the time. Not all qualified intermediaries can work in all 50 states. We can here at Security First Exchange. We meet the Nevada regulations. Some states have regulations for QIs. Most don't. Nevada does. So I can work in all 50 states, or I should say the exchange company can work in all 50 states. So if I have a client selling property in Hawaii or California or New York, doesn't matter. Any place, they can use us and we can help them on their sale and their purchase.
Okay.
And they do have to stay in the United States when they do a 1031.
Okay.
So you can't move out of the country. Every once in a while I get that. They want to buy a rental maybe in Mexico, in Cabo San Lucas or something like that. It doesn't work. You've got to stay in the U.S.
You got to keep that money here.
Yeah, because that's how the IRS can track you.
Yeah.
If you move the money to Mexico and then you sell that property in 5 years, they're never going to know you sold, so they're never going to get those tax dollars back.
Yeah.
So everything in the U.S. Now, they do let you do a couple territories. The U.S. Virgin Islands, Guam, Northern Mariana Islands, you can exchange in and out of as well.
So you have to reinvest here. But what if you live out of country? How does that work?
So you're like a foreign investor doing 1031s?
Yeah.
That's a great question. It gets a little complicated. Can foreign investors do 1031s? Yes. As long as they're filing U.S. taxes and have a U.S. tax ID number.
Okay.
Because they've got to be showing that property as investment property in the U.S. Well, how do you do that? You file taxes every year. So you can declare the income, you write off expenses of ownership. So they got to be filing taxes here.
Okay.
But the one thing that a foreign investor cannot defer through 1031 is the FIRPTA tax.
Yeah.
So there's a FIRPTA tax that foreign investors have to pay up when they sell a property in the U.S. That is not deferred through 1031.
Okay.
So they have
no
to
matter
pay
what,
that.
they're going to have to pay that.
Yeah, but they would defer the balance. They would defer their capital gains and the
gains.
recapture of depreciation and those other taxes that come up through the 1031 process.
We're talking about some interesting things that I had no idea about, new policies and tax policies and things like that.
Yeah.
And I remember hearing about it because it was a big hoopla, like they were trying to get rid of 1031 exchanges. Yeah. So let's talk a little bit about that.
I don't want to talk about that. So for years, I've been in the industry since 2001, and there's always been talk about limiting or eliminating 1031 because congressional representatives say we need to get more money to pay for other things. So let's get rid of 1031. That's just one of a number of things they could get rid of. But 1031 is always on the chopping block. So we're always paying attention. Real estate professionals are part of NAR. We are part of FEA in the 1031 world. It's called the Federation of Exchange Accommodators. Well, what's that? That's our trade organization. And what we do is we make sure that 1031s aren't going away.
Yeah.
So most recently, over the last couple of years, under President Trump in 2017, there was a original call under that tax bill to eliminate 1031s. And bluntly, a delegation of us rushed to DC for just a couple of days, and we were able to save the 1031 exchange. It was almost eliminated completely. And that would have been,
That's crazy.
It would have been terrible for the industry.
Yeah.
And again, not for 1031, but for real estate. Because here's some numbers I didn't even mention, so here we go, some surprises. NAR has done a study that over 15% of real estate transactions have a 1031 attached. And that's residential transactions. If there's no 1031 anymore, there are some people that won't sell.
Yeah.
And we call it the locked-in effect. Because, well, I'm going to have to hold it longer to make more money to pay my tax.
Yeah.
So let's say half of that 15% say we're going to sit on it longer. Eliminate 1031s right away, 7.5% reduction in transactions.
Yeah.
Well, we've seen reduction in transactions over the last couple of years. Nobody wants a reduction in transactions because that's not good for real estate professionals, for title companies, for appraisers, for lenders. It's good for nobody involved in real estate. So under the Trump bill, we were able to save it. But over the last couple of years, under President Biden, they've called to limit 1031 exchanges to $500,000 in gain. So basically, if I bought a property for $1 million and I sold it for $2 million, I would have $1 million gain I would pay tax on. Well, under that proposal, you would only defer tax on the first $500,000.
Yeah.
You pay tax on the second half.
Nobody wants that.
It didn't happen, but that was out there every year. It was in his budget, which never got passed. Well, now that President Trump has won the election, we're watching 2025 because all of those tax cuts under the Tax Cuts and Jobs Act of 2017 are going to expire at the end of this year. So the question is, they have to pay for those renewal of those tax cuts, which they're estimating at over $5 trillion.
Yeah, that's a lot.
They got to pay for that someplace.
Yeah.
And so 1031 could be a pay for. Eliminate 1031 to pay for those tax cuts. And 1031 elimination is a drop in the bucket. Some people are estimated around maybe $20 billion a year, which that's nothing for everything.
And it's going to hurt a lot of people.
How 1031s drive the economy. Again, we've done studies. We hired Ernst & Young to do a study for us. 1031s in 2021 supported over 970,000 jobs, generating almost $100 billion in revenue. If they think they're going to cut 1031s to bring in $20 billion, but we drive $100 billion in revenue, you're actually losing money. So what we do, and I've lobbied many times on Capitol Hill with our industry. I've sat with many representatives saying, giving them numbers on a state level and federal level, how this would hurt their district, how their state or the country. And some listen, some understand, but there's always a turnover in Congress. Every 2 years, there are new representatives. So we go back there every year and lobby to make sure they understand the importance and the value of the 1031 exchange. So 2025, I think it's going to be a big year. So if something comes up, we're going to put a call out. And we're supported by all the major real estate organizations.
100%.
NAR, CCIM, ICSC, SIOR, Commercial Roundtable. Everybody knows the value of 1031, and they support the maintaining of it. No limiting, no elimination.
So one thing I kind of missed on that we're going to go back to, tax years, end of the year, taxes. You sell your house right now, your taxes are due in April. So how does that work? Because I know it's either from the point you sell your house, 45 days, 180 days, or when your taxes are due, whatever comes first. Now, how does that work?
So, it only affects taxpayers that sell their relinquished property between basically October 18th and December 31st.
Okay.
Because if they sell a property at that point, their 45 days is still only going to be 45, but their 180 will go past April 15th. So what if you sell December 31st? Let's make it easy. If you sell December 31st, your 180th day would be June 29th. Well, April 15th pops up in the middle. But you sold your property in the previous tax year. So what if you're not going to be able to buy your property or close on it until May? You can't file your return in April. You've got to file an extension. You file an extension on April 15th. That will give you all 180 days. So now you have until June 29th. So you need to make sure that you talk with your tax professional. Again, another reason the tax professional has to be involved. They know you've got a pending exchange that started in 2024, but now we're in 2025. So they're going to say, we file an extension. Now we get all 180 days, finish the exchange, file the final return. And it's not a big deal. It happens every year for taxpayers doing exchanges, like I said, October 18 to December 31. So it just happens. But what do you do with your tax person? Like I said, just file an extension. You're done.
So that's so important to have your team and your network, because if you're doing a 1031 exchange, I tell my people that want to buy and sell a house without doing a 1031 exchange is get a game plan first. Get your numbers down, get what you're going to sell your home for, and make sure there's things on the market that you want to invest in before doing that. So don't go run and sell your house and expect to do a 1031 exchange without consulting with professionals like myself, and we'll consult with him, and we'll consult with your tax person, and we'll all work together to make sure that transactions run smoothly, and you don't have to try to ask for an extension when you don't get one. You know what I mean? So that's very important to have all your ducks in a row to make sure that transaction goes smooth.
And call us and ask those questions before you ever sell the property. I would say don't even list it. Yeah. Understand what you're getting into with the 1031 exchange. That way you understand you have the 45, you have the 180. Every once in a while I have a client that says, I'm selling a $500,000 house in California, but I don't want to buy a $500,000 house. Well, you need to know what you're getting into. You need to know that you're going to have some tax liability there. Maybe it will affect on your return. What if you're retired and you're on Social Security and Medicare? Mm-hmm. You're going to receive some income that year, and that can actually affect your Social Security and your Medicare benefits. Yeah. So you might end up talking with your tax person and then saying, well, we're not going to sell right now because I can't have that affect my benefits. So there are a lot of people who need to be involved, but you're right. A lot of times, what do people do? Oh, I'll just sell. And they just jump and sell. Okay. And now they're under the gun. And now there's all this pressure. Get the questions answered up front. 100%. Have the conversation with your real estate professional, with your tax professional, with your qualified intermediary. Know what you're getting into. Have a game plan. Yeah. That's the best way to do it. That's what I always recommend. Yeah.
How do you like those calls? I just sold my house. I want to do a 1031 exchange.
We set up exchanges last minute all the time. Like I mentioned before, we just have to set up the exchange before the sale closes. But it's not uncommon for someone to call me and say, oh, by the way, we're closing on Friday and today's Tuesday. So we can still get it done. Don't get me wrong. But those are the clients that then have some issues down the road.
Yeah.
They didn't understand everything. And at the last minute, maybe I don't have time to counsel you for half an hour or an hour and tell you all the details. So understand what you get into. Obviously, preparedness is important.
100%.
Yeah.
And my job is to take all that stress away. So if you don't consult with a professional beforehand, you come see me, and you just have to deal with that stress if you do last minute. It's one of the most stressful things you can do in your life.
Oh, yeah. Terrible.
So, if you're still with me and watching, I hope you found a value in this content. It is very important, 1031 exchanges, if you're building your portfolio and looking to transfer those capital gains taxes and not have to pay them right away. And it's very important to, talk with professionals like I'm doing now, because I know 1031 exchange, but I'm not a QI, so I refer these people to it. So if you got value from this, hit that like button, hit subscribe. Thank you guys so much for watching. And Carmen,
thanks, Shay.
I appreciate you so much.
Of course.
It was so valuable. There's so much I've learned from you doing this video, and I hope you guys learned it too. And as always, stay curious, keep exploring, and I'll see everybody on the next one.